Welcome to today's podcast. Thanks for joining me as always. So at the time of this recording, it's February. I can't believe we've already reached February in the year. It just has flown by. It just feels like we just got past the holiday season. So it's always a constant reminder how quickly things roll. So what's starting to uh, uh, become more apparent for this year is our tax situation. Tax season's about to kick off. You're probably seeing it within your mail. Your tax documents are being sent to you, and the CPAs and enrolled agents are prepping all the organizers and getting things rocking and rolling for this season. Some people will be negative about it, but some more positive. And it may sometimes feel that taxes are just a one-time event for a lot of people, and you may feel that way. It's one of those painful experiences as we get closer to April that we have to experience. But the tax code really and taxes overall really influences so many aspects of our lives throughout the year and impacts so many of the financial decisions that we make all through life. Sometimes we are not really aware of it. It just kind of almost sort of surrounds us, and we can easily ignore what is happening. And for folks who are not designing around that, designing their lives and making decisions around it, there's a possibility that either A, you're leaking a lot of money and wealth over a course of time that is unnecessary, and you may be missing opportunities that could improve your life and certainly your wealth building. And so today I'm just want to walk through just the different ways that the tax code really touches our lives, from kind of how we earn it to where we're saving it, how we invest it and use our wealth, and even how we transfer it to the next generation. All could have a very good or negative impact on our wealth and our livelihood. And we just need to be aware of it. And as a reminder, this is not tax advice, right? These are just my sort of thoughts around what I've seen and experienced through my own sort of experience with it and my connection with tax professionals and helping learn from them what they've seen when it's worked or hasn't worked, and what things that we ought to be thinking about as we're sort of going through this crazy life of ours and trying to figure out how to efficiently build our wealth, deploy it, and use it, and serve ourselves and our families at the highest level. So it is something that I would certainly encourage you to start thinking about. But in reality, taxes are not a bill. They are basically, the tax code is a system, right? It's meant to help sort of dictate, and why do governments create these rules? Well, they're trying to drive behavior, right? And put in place certain sort of parameters for us to follow or not follow, and that will dictate our tax situation. And obviously they use some of that revenue too, but primarily it's helping to drive behavior. But unfortunately, most advice around taxes is fairly reactive. And so this is why I'm glad you're joining me. If you're listening to this, that you can get some proactive sort of advice and start thinking about these things, and maybe even bring it up to your CPA or enrolled agent. So let's just walk through this in a very high level, and we'll kind of go through some details on maybe some things to think about and consider. So the first obvious area to start with, especially as you're earning money, we need money somehow coming into our lives, right? Through how we make money. And for a lot of folks, right, what we're taught is, go to school, get a good job, right? Get employment, and we go on our way and we save, and we'll get into those sorts of topics. But from an income perspective, a lot of people who are what they call W-2, and they earn an income, they earn that income, whatever, how often that comes through, biweekly, weekly, whatever, monthly, and taxes are withheld through that, right? And it's considered ordinary income and active income. And that is typically the highest tax bracket, right? You're going to experience a lot of taxes, and as your income grows and your tax rates grow, right, in a graduated scale. And that's just how the system works. And sometimes people are not looking at this historically, it probably feels like high taxes. However, we are at some of the lowest tax rates historically, if you look backwards. But for those who are employed, working a job, you're likely going to experience the highest tax rates that are out there. And so you also get hit with payroll taxes, obviously on the front end, like to pay for Social Security, Medicare, right? All the social programs. So that's all sort of buried in there too and withheld. So obviously the IRS wants their money before you decide to spend it. So they withhold it so they can make sure they get their pound of flesh early. So you're paying them up front first. And that's what companies are required to do. So it's not the most efficient model, right? Because they're withholding a bunch of your money and then you got to go file and maybe get some of it back that you've already handed off to them all throughout the year. And think about this from a incentive perspective is they're not really incenting people to just work a job and consume, right? They want producers. And who are the producers? Business owners, right? Business owners are the ones that are creating new opportunities, new technologies, services, and employing people, hiring vendors, and spurring economic development. And so from that perspective, business ownership can have some serious benefits from a taxation perspective because, they want people to create businesses, to employ people, all those sort of things, buy assets, right? So they're definitely incenting those sorts of things so that people would take on that risk, right? So that there's a lot of things that go with business ownership, obviously some lower tax brackets, as well as the biggest one is centered around that employees will get taxed first and then essentially live off whatever is left. And that's kind of usually the rhythm of most people are having to deal with. On the business side, there are opportunities where legitimately, right, that expenses that are kind of part of life can get folded into the business. And then the net income from that is what gets taxed. So unfortunately, most people are getting taxed at the gross level, right? They have to spend whatever's left over after taxation. Well, business owners recognize that, hey, I'd rather have more expenses and less income, net income, to be taxable down by the IRS, so then they can structure it that way. And that's just one of the basic concepts around business ownership. But there's a lot of incentives around business ownership, things that you can deduct and operate, and buying things for the business can be depreciated fast, so you can experience those losses faster and apply them against income. So there's a whole host of things in the business world, research and development credits, things of that nature that really could benefit a business owner. But by and large, a big one first is just how the income comes in can be very tax advantaged for business owners. Shifting gears a little bit, obviously income comes in whether through business, through your W-2 income, maybe investments are creating some income too. But then we got to go save that money, right? Obviously, before we go invest it, we should save it. And saving, from my perspective, the way I define it is more where you're parking cash that is safe, liquid, accessible to be used for future purposes, to spend, invest, etc., donate. And so most people are probably putting it to things like bank accounts or even a brokerage account. That's usually it. Some of the people sort of mix this up with 401ks. We'll talk about that later. That's more investments. But from a savings perspective, that's usually where the default will go. Put it into a bank account, brokerage account. And even if you earn anything on that, which would be pretty small, right? From a saving perspective, like savings account, think of that, money market accounts. Typically, most of those things are going to churn off taxable interest as well. So anything small amount you might earn from those accounts, they're going to be taxed by the government as in ordinary income, right? Which is taxed at the highest tax rates. So again, you're already taxed on that money already because it's whatever's left over from the income tax. But then you start earning from that, then it gets taxed again. So it becomes a perpetual sort of rhythm. Obviously, it's good because you need cash. We need some liquid savings, emergency funds, all those sorts of things, more opportunity in my mind funds. They're liquid. It's pretty simple, but you really don't get a lot of other benefits from it, no deductions or anything like that. And so one of the things to consider that could be alternatives to this or thinking about this, obviously, some of these pre-tax vehicles can be used. However, you lose a little bit of access to them and liquidity. So unfortunately, that's not really ideal in that case. There are some other options. You can think about Roth and IRAs type of world to save, but again, that's more investment type stuff. You can access that. One of the best places we enjoy is cash value life insurance, used properly, designed properly. That could be storing cash there very efficiently in a tax sheltered environment that could be accessed through loans or withdrawals. And so everything sits in there taxed, not tax deferred on paper, and we can design them so it's always tax free. So just some ideas as to find more efficient ways to store our wealth, and so or avoid some of these little leaks that it seems sort of innocuous, but over long periods of time, if you're storing a lot of money in places, well, that could add up quite a bit. So obviously we've earned it, we saved it. How about investing? So obviously when we're thinking about investments, the natural inclination for folks as they're investing, it's doing their 401k plan right at work. That's usually the most obvious, and that's typically funneled into mutual funds for the most part. Pretty much all is available for most employees. And so you're just relegated to that asset class, whether you like it or not. But it's also money that is, yes, you get a deduction on the front end, but then you will have to pay taxes on the back end at an unknown sort of tax rate, right? That could be good or bad. Obviously, if you're younger, the likelihood is you're probably in the lower tax bracket now than you are in the future. But again, it's hard to know. And that's just sort of a game we have to play and sort of recognize that a deduction now doesn't mean you're going to have tax savings later. It's a possibility. You just don't know until you start using the money and what tax rates will be. And most of it is in things that are mutual funds, things that, they're plain vanilla and not a lot of options. There might be a lot of churn in there. Obviously, if you're doing this in a brokerage account, you're probably going to be subject to more fees and sort of transaction fees and such. So that could add into the fee structure that you may experience along the way. So that's separate than taxation, but certainly something to consider. But you will likely in those scenarios get hit with taxes if you're outside of a retirement account. If you're in a brokerage account, you might come up with capital gains taxes, which is taxed lower, which is good. But there might be short-term capital gains that are generated from mutual funds and such that you will be hit at an ordinary level, right? So those are things just to consider. And there is a scenario where your mutual fund could lose, but you might have a capital gain, right? So it's easy. It's something that we're all used to, stock market, they talk about every single day. And so it's something easy for people to get into, low dollar threshold to get in from an investment side. And you could almost set and forget it. And that's what I guess is sort of attractive to a lot of folks. They don't really have to think about it. It becomes a mindless robot process to just shove money into markets and play passive indexing, whatever, and hope that in the long run, it'll be there for you to use and at least exceeds inflation. So what are some other options to consider? Obviously, we talked the markets, and there's a book that I would highly encourage you to read is the 7 Assets That Government Will Pay You to Make by Tom Wheelwright. I found it very interesting and really frames this up nicely to think about what are the investments that the government's incenting people to get into, and they're driving certain things like getting into real estate. They want to obviously have places for people to live, right? As an important aspect of life, shelter. So we need people to build those things to be able to house folks, right? There's energy. We live on so much energy and consumption in our world. We need investments in oil and gas and alternatives, solar, all those things. So what if you could actually invest in those things and get some tax benefits from them? There's obviously and I mentioned earlier around certain assets, real estate, stocks, bonds, whether businesses, like capital gains, like investing in those areas, if you're holding them for over a year, you can benefit from capital gains tax rates, which are lower than your income tax rates. Definitely encouraging people to invest in those areas so you can get favorable tax benefits on the other end. And you have things like opportunity zones where they can to incent investment in sort of undeveloped areas of the country that maybe have been lacking investment. You can invest potentially some gains, capital gains that you've experienced and transfer over to the opportunity zones to help further develop those areas that maybe wouldn't have gotten it. And there's some really favorable tax benefits there. Again, something to consider and look into for investment longer term, because there are some issues with, access to those funds. Is if you don't need them for 10 years, it could be a really good way to invest and then sort of reap some tax-free money on the back end of all those gains. So just some things to consider and talk through and think through with your advisor and tax professional if that's something viable. So these, again, they're just some options for you to consider and think about. It's back to incentives. What does the government want us to do, and help sort of support the things that they feel are important to drive our economy, support our country, and put us in the best position to continue to grow and thrive. I guess on the last sort of piece of this, I want to sort of reiterate that, there's so much focus on returns, right? Whatever number that is, and such is important, but the more important piece out of that is also the risk that you have to take to get those returns. But then in the topic we're talking about today is what's your after-tax sort of return after in the end, right? You can have some big, large number, but if a lot of it's subject to taxes, then what you're netting out of it is really key. So let's go to stage 4. The fourth part of this is how we use our money. Obviously, we're taught to just accumulate wealth in certain areas, whether it's qualified plans like 401ks, IRAs, put them into businesses, others, real estate, et cetera. But then how do you use that money, right? And this is, I guess, considered like distribution. We eventually have to use some of that money. Now, granted, I would really encourage you, on a separate sort of note here, is to identify investments that maybe pay you along the way, right, as you get used to them. But we are often taught to just squirrel away into things and then use them someday, right? Things in real estate, private lending, other things that can generate dividend-paying stocks, like something to generate income now, I think is key. So this is more broadly speaking of assets you're building, and then you wait for, say, maybe retirement or later stages in life to use. So when we think about retirement accounts, and we see this for a lot of folks that have done really well, done the right thing, they build up assets, and now they've got accounts that are now going to be the main source of income for them down the road. They are potentially tied up in accounts that had been tax deferred for so long, but now you have to pay the piper, right? To use those assets, you have to pay the tax on it. And it actually prevents some people from actually using and enjoying their money as much as possible, right? If you didn't like paying tax on the front end, how enjoyable it is on the back end. And so, unfortunately, a lot of people are facing this, that they've done so well, done the right thing, and you may be one of those people, and now you're looking at a multi-million-dollar retirement account. You're like, oh my God, to get $100,000, I got to pay tax on that whole thing. And so these are types of things that people are facing now that done really well, and because they not have planned as well leading up to it, now they're subject to significant taxes on the back end to just enjoy and use their wealth. Other things that for consideration, not so much taxation, but there's an element to it, is, depending on if Social Security, Medicare costs and such matter for your situation, increasing your incomes in those times may impact how much of Social Security gets taxed, how much Medicare premiums you're going to face, right? So these are all sort of coordinated efforts that you need somebody, or you need to look at to see how to optimize that, because you may inadvertently increase your Medicare costs or your Social Security taxes because of how much income you're pulling from taxed deferred accounts. So it's really important to sort of take a look at that. Obviously, when we're dealing with the accumulation phase, you can deal with the volatility. Is just part of the cycles, but they feel worse as you're trying to create more systematic income from them, right? The volatility events can be very catastrophic or cause an emotional sort of strain and stress when you're having to actually use that dollar to ensure that it can last forever. Something else to consider on the sort of, to combat some of this is to leading up to retirement, and for folks who are maybe 10 years out, but certainly 5 years out from maybe retiring or shifting gears and trying to use assets for income, is to get ahead and start planning for that. There are strategic ways to do, say, Roth conversions, right? You can't do those over large numbers, right? Because that'd be a hugely taxable event. But to do that strategically can be very important. And you can even couple those sort of Roth conversions with some tax strategy, right? Proactive tax planning to mitigate some income for years to help you do those Roth conversions. So that can be really important to consider. Obviously, tax planning is a key component of this, but also trying to make sure that you can sequence and coordinate all the different aspects of your different accounts, when to use them, how to use them. I think this is where it's so key to get with an expert in retirement income space to really map that out to you so you can most efficiently manage the use of those dollars. Because at some point, especially for qualified money and 401k money, at some point when you get older, you're going to have to withdraw even if you don't want to, because the government wants that money finally. So leading up to that, that's why you need to figure out other ways to get it into tax-free zones like Roth IRAs or even cash-value life insurance, other things that have no tax impact to them. So those take some time in planning and coordination along the way, and sequencing when you experience those things so that you can have the least amount of taxable income, and then hopefully it doesn't impact Medicare and Social Security. So the last stage of this we're going to cover is around wealth transfer. Unfortunately, there is an end to this. We are all mortal, and it's not something we like to talk about often. However, we do need to plan for that. And for a lot of folks, even today, I come across, they don't even have their estate plan in place. But the reality is they do. It's just the government's plan. So it's important to get ahead of this, sort of map this thing out. Now, obviously, one of the things that may come to mind from a taxation perspective for most people is estate taxes. And given today's current rules around this, you have to have some significant wealth for that to matter, right? So for most people, you won't experience, at least today's rules, an estate tax problem. I think, I don't know, it is around 12, 13 million a person. So if you have a net worth above, that amount, 26 million across or higher for you, married couple, then you will not be subject to estate taxes. However, if you haven't planned accordingly and, set up your assets into living trusts or some remote trusts, then you are likely going to be subject to probate. And probate comes with costs and fees and such. You pay attorneys, and because people haven't done anything with that, then that will be subject to costs. Someone has to go probate. It's a public sort of hearing and legal proceeding, and then so all your information is out and open, public, and there's going to be costs associated with that. And so any of your heirs that you care to leave wealth to may be impacted by that. So although that's not a tax, there is essentially cost to that could be sort of mitigated if you kind of do the upfront work. Spend the time now, spend some money now to reduce some big costs on the back end. So taxes for sure. A big thing with wealth transfer too, things like 401ks, IRAs, those don't, even if you die with those things and pass them on to the next generation, they don't get stepped up in basis. They have to actually be taxed someday. So your heirs will have to liquidate those assets, within 10 years. And then if they are in those tax deferred buckets, they'll have to eventually pay taxes on those. So those never go away. They're not going to forgive you for those things. So it may be wise to consider maybe having less of that money there so that and transfer them to tax-free zones. But one big concept, just to throw at you, just for thinking about it, there's this idea of buy, borrow, and die. You don't have to borrow to do that, but just follow me for a second. A lot of their strategies, you buy assets instead of liquidating them and suffering some capital gains taxes or taxes in general with them, you borrow against them, use them as collateral, and then when you die, that asset, they call it current law, you stepped up in basis. So any of the gain that you had in those assets, when they pass, they get forgiven by current date rules. But when you're borrowing and to create income and use those assets and consume them, borrowing is never a taxable event. So people buy an asset, say a piece of real estate, borrow against it, use it as collateral, and to consume the income and equity in that asset. And then when you die, that asset is relieved of any taxation, and it can be used to pay off maybe any debt that was outstanding on that asset, and then no taxes have been paid. So that's just a concept that could be used with real estate, businesses, stocks, bonds, life insurance, like that's all part of the same sort of rhythm that and strategy you can deploy. And then when you pair that up with a good trust and entity structure, you have a tremendous sort of package together that can help avoid probate and the costs associated with that. If you interstate tax problem, avoid that as well legally. If you plan accordingly for like a irrevocable trust work, and then you can avoid capital gains because you have assets that can be stepped up in basis. So these are all sort of just concepts for you to consider. Obviously, that requires a bit of planning, and for some people that might be overkill. But as you are growing in assets and complexity and wealth over time, these are things you can start building into if you're looking to, really get coordinated across to shield taxes, lawsuits, right? And fees and costs with probate, all that stuff can be managed through that. So that's just something for you to consider, think about, and it's definitely worth its weight to get the right people involved, team involved with your advisor, to your state attorney, the TPA, to make sure you're kind of aligned with that and it's set up in a proper manner. This hopefully gives you sort of an idea where taxes are playing such a complicated role in our lives in so many ways. And it's really incumbent upon all of us to, we're earning our wealth and how we're earning it, protecting as much as we can legally and using it for good, right? Hopefully we can put it to work in things that the government wants us to do, and then we're benefiting society and ourselves and our families. So, to me, I think of the core problem around this isn't the tax code so much. It's that a lot of folks who are just so busy in life, maybe are not having a CPA or enrolled agent or advisor or really helping them think through these things. And so it's a more reactive sort of approach to taxes. And as we're going through our lives to saving, investing, and all these things, without the help of others or time commitment from even you to be able to tackle these things, a lot of these things are left unattended to and very efficient, uncoordinated, and it just leaves people with added risk and inefficiencies in what they're doing with their wealth that can be managed if the right attention and team is put to it. So why not sort of get ahead of that and plan and take advantage of the tax code? I mean, it's not a system that is broken. It's just that it just rewards people who are planning properly for it in all facets of their life. So to me, a smarter approach is to actually get ahead of it, start discussing these things or learning about these things that hopefully will drive you to explore this further, and then getting a coordinated team and quarterback involved to help you think through these things, because there's a lot of things and moving parts and you can't tackle it all at once. But, as you're building across this and building your education and knowledge on these areas, they just sort of build over time. And you start mapping out your plan of how you're approaching your wealth and where all of it hits on a tax level, so that you can be assured that you are keeping as much of your hard-earned money and wealth for yourselves, for your families, and for the next generations, or for the things that you care most about, so you can deploy those resources for what is important to you. So I hope this episode was helpful, gives you some food for thought to really sort of plan more proactively with your wealth building and taxation, and not treat it as a negative thing. It's a positive thing. If you can deploy wealth to support the government, what they're trying to do, and to spur the economy, keep more wealth for you so you can invest more in your business, your families, your education, and put that to good use, all of that can be seen in a much more positive manner than, oh boy, I got another tax bill to pay. So hopefully this was helpful, and we'll catch you on the next episode of the Perennial Pride podcast. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it, and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances, so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.